Most traders do not fail because they lack a method. They fail because they cannot keep their hands still. They think the market is a place for constant action. In their minds, every hour must hold a trade, every fluctuation must be answered, every quiet moment must be filled. They cannot bear to watch the tape without doing something about it. The truth is cruel and simple. The market does not reward motion. It rewards judgment. You may have a strategy, you may have rules written in a neat notebook and lines drawn carefully on your charts. But if you cannot wait when there is nothing to do and act without trembling when the time has come, you will join the long line of men who mistook busyness for skill and paid dearly for the confusion. What you're about to hear is not meant to soothe you. It is meant to confront you. If you cannot tolerate that, you are not ready to speculate. If you can, you may yet learn why most traders disappear and why a few last. Before we begin, do one thing for me. Subscribe to this channel, like this video, and leave a short comment, even a single word. You will help this message reach more traders, and you will tell me this work is not wasted. Now listen closely. Every trader begins with motion. He opens his first account, enters his first position, and once the trade is live, he feels something he has never felt before. The intoxicating mixture of danger and possibility. The market moves. His heart moves with it. A small profit appears. He feels 10 feet tall. A small loss appears. He feels 10 feet under. It does not matter what he tells you he wants. He may say he wants freedom or wealth or independence. What he really wants is sensation. He does not yet know it, but the market is not testing his intelligence. It is testing his appetite for boredom. And in that examination, most men fail. I know because I failed it myself. When I was young and first trading off the tape, I believed the secret lay in never letting an opportunity pass. If a stock moved, I must act. If a price ticked, I must answer. The idea of sitting with idle funds while the tape printed numbers felt like a sin against my purpose. And the market punished me for it. Not always at once, that's the clever part. Sometimes I was rewarded for my restlessness. A quick in and out would show a profit, and I would tell myself I was clever. I called it taking what the market offered. In truth, I was taking what my impatience demanded. I mistook constant trading for mastery. I thought I was reading the tape. In reality, I was chasing it. What I did not yet understand was this. The market favors the man who can outwait it. Most will not. The greatest confusion in this game is between activity and progress. A trader sees a quiet day and says, "There is nothing to do. I must find something." He scans every list, sketches every possible setup, and forces the market to present an opportunity it has not truly offered. He will call it being proactive. It is nothing of the sort. It is restlessness disguised as diligence. Then, when a true opportunity finally appears, he is already tired, mentally spent from a dozen needless trades. His capital is weakened, his patience is gone, and his nerves are frayed. The very moment that deserved his full strength receives the leftovers of his attention. The successful operator behaves differently. He understands that most of the time the market is not worth his effort. Prices drift without conviction. Movements cancel each other out. The tape writes nonsense between the lines of meaning. During those times, he waits, he studies, he prepares. He does not confuse sitting with stagnation. He knows that in speculation, waiting is work. Some of my largest campaigns were born not from constant trading, but from long stretches in which I did almost nothing. I watched the leading groups. I watched the general market. I watched how the strongest stocks handled pressure and how the weakest behaved under relief. The tape was telling a story, but it spoke slowly. Most men walked out before the ending. They rushed to another stock, another market, another distraction. I stayed and listened. When the pivotal moment finally arrived, I was ready. They were not. Most traders will tell you they believe in the trend. They speak of it as if it were a friend of theirs. But listen to how they trade, and you will see the truth. They love the idea of the trend, but they cannot bear to follow it. When the general market is in a broad advance, there will always be days of reaction, pullbacks, pauses, the ordinary breathing of prices. On such days, the weak trader loses his nerve. He declares the trend dead, the move over, the bull finished. He sells out his positions not because the primary movement has changed, but because his stomach has. Then, when the market resumes its upward march, he is left watching from the sidelines. He calls it prudence. It is not prudence. It is fear. In a bear market, the same thing happens in reverse. There are rallies, sharp, sudden, seductive. The weak trader forgets the larger decline and leaps back in, convinced the danger has passed. He is answered by a fresh leg down. The operator who survives does something different. He studies the line of least resistance, the true direction beneath the noise. He does not panic at every setback, nor rejoice at every small victory. He is loyal to the big swing, not to every little jump along the way. It took me a long time to learn this. I remember more than one campaign in which I was right on the main movement and wrong in my own conduct. I would enter well, sit for a while, then let some ordinary reaction frighten me out. The stock would shake me off like a rider who lacked the nerve to stay in the saddle. The trend did its job. I did not do mine. This is the cruelty of the market. You may be right in your judgment and still lose if you cannot behave. Then there is the matter of how a man builds his position. Most amateurs think in terms of one trade. They imagine themselves as bold generals who march into battle with their full army at once. They empty their capital into a single entry and call it conviction. When it goes well, they boast. When it goes badly, they disappear. The skilled operator thinks in terms of a campaign. He does not arrive with his entire force on the first move. He sends out a small line, a pilot position, a test of the ground. He wants to see if his reading of the tape aligns with reality. If the market accepts his presence, if the price behaves as it should, he adds. If not, he retires at a small cost and lives to form another plan. I never made a habit of entering at full size from the start. Not because I doubted my edge, but because I respected the market's right to contradict me. In a proper advance, I would pyramid, not recklessly, not at every tick, but at distinct points where the stock proved itself anew. Each addition had to earn its place. The price must move my way, then pause, then move again. Only then would I enlarge my line. Most traders do the opposite. They increase size into weakness and decrease it into strength. A stock drops below their entry. They add, calling it improving their cost. A stock moves in their favor. They trim, claiming to lock in profit. In other words, they feed their worst trades and starve their best. They are not building an edge. They are building a trap. Another fault that destroys more accounts than poor analysis is the longing to be present in the market at all times. Some men feel uneasy when they are flat. They cannot see the tape print without wanting a piece of it. To them, an idle account is an accusation. They will trade every little movement, invent reasons to be involved in dull times, and call it staying sharp. In truth, they are dulling themselves. Their capital bleeds from 1,000 cuts. Their judgment is worn out by trivial decisions, and by the time a genuine opportunity appears, they no longer have the patience or the funds to seize it. I had to learn by painful experience that being out of the market is also a position. There were seasons when I did not like the action. The leaders were tired, the groups were conflicted, and the averages told no clear story. In those times, I stood aside. I watched. Men called me timid. They said I had lost my nerve. But when the picture cleared, when the tape began to speak plainly again, I had something they did not. Capital, calmness, and clarity. They had traded themselves into confusion. I had weighted myself into readiness. The market rewards the man who knows that no trade is better than a bad one. This sounds like a platitude. It is not. It is the dividing line between those who last and those who blow up chasing shadows. There is another form of impatience that wears the mask of courage, the urge to recover quickly. A trader suffers a loss. It stings. Instead of stepping back to ask what went wrong, he plunges into the next trade, often larger and less carefully chosen than the last. He does not say it aloud, but the thought stands behind him. I will win it back at once. The market has a neat term for this habit, self-destruction. I remember a time when a sharp reversal cost me more than I cared to admit. My instinct, The same instinct that lives in every trader urged me to jump back in, to prove to the market that it had not beaten me. But the market is not an opponent. It is a condition. You cannot answer it personally. You can only adapt. On that occasion, I forced myself to do nothing. I went through my own trades line by line. Was my reading of the trend wrong? Did I break my own rules? Was the loss a fair cost of doing business, or the result of my stubbornness? By the time I returned to trading, the desire to get it back had cooled. In its place was something far more profitable, a renewed respect for my own rules. Most traders never allow that cooling to happen. They trade straight from the wound. They are not trading an edge. They are trading their frustration. The market does not know this, but it does not need to. The result is always the same. We must speak also of systems. Most men, if pressed, will say they have a method. But listen carefully, and you will find that what they truly have is a collection of habits, superstitions, half-remembered ideas, and hunches. They enter when they feel like it. They risk whatever portion of their account seems reasonable that day. They exit when their nerves have had enough. This is not a system. It is improvisation. I am not saying your method must be complex. In fact, the simplest systems are often the best. But it must be yours, and it must be clear. You should be able to answer, in plain language, when do I enter? How much do I risk? Where do I place my stop? Under what conditions do I add? How and when do I exit? If you cannot answer these questions, you are not a trader. You are a spectator placing wagers. When I began to treat my trading as a business rather than an adventure, everything changed. I wrote down my rules, not vague sayings, but specific conditions. When I broke them, I wrote that down too, and studied the result. The market is chaos. Your only defense against that chaos is structure. Without a structure, every loss feels personal and every gain feels mysterious. With a structure, both can be understood. You may still lose, I assure you, you will, but you will know why. And knowing why is the first step to doing better. There is also the matter of other people's opinions. The street is full of voices, brokers, acquaintances, newspapermen, all eager to tell you what is about to happen. If you listen long enough, you will hear every possible prediction. Some of it may even be right, but it will not make you money. I have taken trades on the word of others. I will not pretend otherwise. I have listened to men who seemed sure of themselves, men whose confidence was contagious. Sometimes their suggestions worked, sometimes not, but almost always I came away poorer, not merely in money, but in understanding. The trouble is not that the other man is necessarily wrong. The trouble is that the judgment is not yours. If the trade succeeds, you learn nothing except that you can be lucky. If it fails, you learn nothing except that you can be misled. In both cases, your emotional reaction is out of proportion because you did not own the decision. I learned slowly and at cost to trust one thing only, the tape. The tape did not flatter me. It did not try to persuade me. It did not care whether I agreed with it. It simply recorded the truth of what was happening. My job was to read it and respond, not to gather a chorus of opinions and then vote. You may learn from others. You may study their ideas and examine their methods. But when it comes time to risk your capital, the decision must be your own. In this market, borrowed conviction spends just as quickly as borrowed money. Both leave you empty. We come finally to the rule every trader can recite and nearly none obey. Cut your losses short. Let your profits run. You have heard it so often it may sound like a slogan on a broker's calendar. It is not. It is the dividing line between those who survive and those who do not. Most traders reverse it. They snatch at small gains, terrified of seeing them disappear. They cradle large losses, terrified of admitting they exist. They will tell you they are giving the trade room. They will tell you they are playing it safe. In truth, they are obeying fear and hope instead of reason. When I kept to this rule, truly kept it, not in talk, but in action, my whole trading life steadied. A losing trade became a line in my records, not a wound in my mind. A winning trade was allowed to grow beyond my modest expectations. The accounts reflected it, so did my nerves. When I abandoned the rule, the opposite occurred. A tiny loss, which might have been brushed away like dust, grew into a stone that bent my back. A small profit, taken too quickly, prevented me from enjoying the full benefit of my correct judgment. The damage did not always show in a single trade. It accumulated quietly. Traders do not fail because they never heard good principles. They fail because they never learned to suffer the discomfort of following them. If you master only this, to close losers while they are still small and to keep winners while they are still strong, you will already be far ahead of the crowd.
If you have listened this far, you have already done more than most.
Many traders will not endure such talk. They prefer secrets, shortcuts, clever tricks. They want a method that allows them to keep their habits and change their results. Such a method does not exist. The edge is not hidden. It is simply hard. You know now the habits that ruin most traders: their need for constant action,
Their refusal to wait.
their habit of adding to weakness and cutting strength, their contempt for structure, their worship of other people's opinions, their fear of taking a small loss, their eagerness to trade from emotion instead of from rules. And you know the principles that separate those who last: waiting when there is nothing to do, acting decisively when the moment comes, building positions carefully only in the direction of strength, respecting risk not as an afterthought but as the foundation of survival, treating losses as tuition, not as tragedy, relying on the tape, not on the noise of the crowd, cutting losses quickly, letting profits live. These are not tricks. They are not fashionable. They do not change with the season. They are as old as speculation itself, and as unforgiving when you break them. Most traders fail. You do not have to. Subscribe now, like this video, and leave a comment below. It tells the world there are still a few traders willing to face the truth, and it tells me this work still matters. Remember, the market is not your enemy. Your habits are. Change those, and the market becomes something else entirely. Not a beast to be feared, but a mirror held to your character. If what you bring to it is structure, patience, and control, what it reflects back may one day astonish you. Stay sharp, trade with reason, and never forget what you have learned.